Hi you guys, welcome back to the channel. My name is Brad. This is the Firefighter's Financial Toolbox. Today we're going to talk about 6 tax saving strategies for smart investors. So we all know we have to invest and we all like to save on taxes. So this is a paper from Vanguard.com and it's written by Jessica McBride, who is one of their senior financial advisors. So let's dive right in. How to choose, sell, withdraw, and donate. Everyone wants to pay less taxes, right? Of course. We're all investing for specific goals, but what we want to achieve varies from one investor to another, but we can likely all agree we want more from our returns going towards our goals and less to the IRS. Amen. I agree with that 100%, right? Save taxes whenever you can, because guess what? You're going to pay them your whole life. Not sure where to start? Consider these questions. Which investments should I choose? Where should I hold my investments? When should I sell shares? How can I make the most of my charitable giving? And what order should I withdraw in? Let's start with number 1. Consider tax-efficient funds. In picking investments for your portfolio, there are a number of factors to think about when it comes to non-retirement accounts. 2 crucial considerations are the investment return and the tax efficiency. Okay, you guys, so they're talking about a taxable account now. They're not talking about your Roth IRA. They're not talking about tax sheltered money. They're talking about taxable accounts, a brokerage account here. Your ultimate goal for your portfolio should be to maximize after-tax return. I agree 100%. Choosing investments with built-in tax efficiencies, such as index funds, mutual funds, and ETFs, is one way you can minimize returns lost to taxes. ETFs offer an additional tax advantage by the way they transact to minimize triggering capital gains. You guys, they do in-kind transfers. So instead of selling a stock to buy another stock, they trade it within it, so it keeps the taxes lower. Because ETFs offer the best of both worlds, low cost and tax efficiency, I often use them. Okay. Remember, this is for taxable accounts she's talking about so far. So think about that. Weigh using funds that are tax managed for savings. Some clients that I work with will be looking for special tax saving strategies. When I build those clients' portfolios, I might choose funds that are managed to add an extra layer of tax efficiency. Some clients prefer active funds. If I can, I try to include tax-managed stock funds in their portfolio. These funds use strategies designed to lower the tax burden for the investor compared to other stock funds. Remember, if it's an active managed fund, every time they buy and sell, it's going to create a taxable event, and guess who's on the hook for it? You, the owner of the mutual fund. Because of this extra layer of tax management, however, tax-managed funds are usually more expensive than comparable stock funds. Yes, so think about that. Remember, if I'm paying an extra 1% for that fund and it's only getting the same as a S&P 500, I'm actually losing a whole percent, you guys. For clients in higher tax brackets, they may consider tax-exempt bond funds, which pay lower interest rates but maximize after-tax returns. So right now, with the bonds being where they're at, I'm not sure too many people are doing munis because, yeah, that's not good. All right, divide assets among accounts. Picking tax-efficient investments is one method to maximize after-tax returns, but you also want to choose the right types of accounts to hold your investments. At the highest level, asset location. And you guys, if you haven't checked out my video, I'm going to link it up here. On asset location is a way to minimize taxes by dividing your assets among your taxable and non-taxable accounts. So you put investments that are not tax efficient, i.e. REITs or bonds, in accounts where they can defer the taxes, and you can hold on to the tax efficient investments in your taxable account. You guys, you want stocks, either individual stocks, or if you don't do that, index funds or growth funds. So funds that are not putting off a lot of taxable money. In fact, then you can pick when you want the taxes. All right, let's go down to number 4. Looking for opportunities to offset gains. As an investor, you're only taxed on net capital gains, the amount you gain minus any investment losses. So any realized losses can help lower your tax bill. Therefore, if you're going to have realized gains, it makes sense to look for opportunities to realize losses to offset them. So you guys, what she's saying here is if you're selling something for a big gain, you want to look to see if you have any other funds or stocks that have gone down, and maybe you can sell those and you can offset some of the taxes because you can write off those losses on the stocks that you sell because it's in a taxable account. For example, if you have shares of funds that have lost value since you purchased them, you may want to consider selling them. The intentional selling of an investment at a loss to lower taxes is known as tax loss harvesting. And you guys, I'll link a video up there as well for this because I have done videos on tax loss harvesting and I think it's a very good tool. If you have a year when your capital losses are greater than your capital gains, you can use up to $3,000 of net losses to offset ordinary income on your federal income taxes. And if you have more than that, you guys, you can actually carry forward that loss to future years. So this is a good benefit. Remember, again, only in taxable accounts. You can't do this with your retirement accounts. Number 5, optimize your withdrawal order. When you start taking money out of your portfolio, make sure your withdrawal strategy factors in taxes. Once you start drawing down from your non-retirement accounts, think about taking all distributions from those accounts in cash, rather than reinvesting them so you don't end up paying taxes twice. A strategy like this is one way to make sure clients keep as much money in their pockets as possible. So how can we do it? And they've got a little chart. We'll go through it. So how can I maximize my withdrawals? First of all, if you have RMDs, you guys, take those, because if you don't, you're taxed on 50% of the RMD. Let me repeat that. So let's say your RMD for this year is $10,000. If you do not take that RMD, you'll be penalized a $5,000 penalty for not taking it, and then you'll pay taxes on the full amount. So take the RMD if you have it. And then consider drawing from your taxable account, because then you can control whether you take long-term capital gains, or you may be able to take money tax-free. Do you expect your future tax rate to be higher? If what they're saying is after you get to this point, you need more money, if it's going to push you into a higher tax bracket. So let's say you're right on the edge of going from the 12% at 80,000 married to the 22%. You may not want to take more out of these accounts. You may want to be able to hold it, or you may use it to your advantage. There's no right or wrong answer for this, you guys. It depends on your individual situation. And you should always talk to your tax attorney before you make these decisions, because you don't want to pay more than you have to. And last but not least, number 6, make the most of your giving. If philanthropy is part of your money purpose, you can give in a way to help lower your taxes. Consider these strategies to make the most of your giving. Itemize cash deductions on your return to take advantage of tax deductions. But here's a thing that most people don't realize. You can gift appreciated securities, such as mutual funds, ETFs, or individual stocks, to minimize future capital gains. Not all charities can accept these, but most can, and you can actually often donate it through a donor-advised fund, which makes it pretty easy. You can donate up to $100,000 annually from your IRA directly to the charity. You can also use that donated money as your RMD if you don't need it. So that's a way that you could possibly save on some taxes. Where if you got the money from the RMD, you cashed it, and then you wrote a check, you would have to pay the taxes on it. So this is a way that you could donate those appreciated stock securities, sell them, donate them to the charity while it's still in the IRA, use as your RMD, and save on that tax money. So, you guys, this is 6 ways that you can save on your tax bill just by adjusting how you invest. And remember, taxes are the one thing in life that never go away. We always have to pay them. So we should always try our very, very best to minimize it. You guys, I hope you got something out of this. If you did, do me a favor. Drop me that like. If you're not already subscribed, you know the deal. Hit the button, ring the bell. If you guys have ideas on tax savings that I haven't hit on in these 6 topics, put them in the comments. I want to hear how many of you are using these particular strategies. Let me know which ones you use, which ones work for you, which ones don't. All right, we'll see you. Thanks a lot.